all our participants. Thank you for joining today's Green Tech Dialogues on High Quality Financial Statement under IND AS Auditor and Company's Perspective, Part 3, featuring Mr. Chandan Lahoti, Partner Aujja Valecha and Associates LLP. Today's webinar is the third and final session of our three-part webinar series. For all those who missed the first two parts, you will be able to access it on TaxSutra Learning Hub. A brief introduction of our speaker. Mr. Chandan Lahoti is a partner with AVA Network and is responsible for corporate development and strategy within the group. Before this, he was with EY for 16 years and was serving as a director and specialized in statutory audits. He has worked on audit and assurance engagement of large multinationals in India as well as overseas. As a part of EY, he has led and managed audit of large listed entities, including the likes of Cummins India, Bharat Forge, Atlas Copco, Eaton, etc. He has worked in diverse industries, right from heavy engineering, automotive, information technology, and startups. He likes mentoring fresh qualified CAs. He has also been an active speaker on various topics at EY India level and at ICAI at different forums. We will welcome you, sir, for the session. Before we dive into today's session, we have last 10 minutes for dedicated Q&A, and all participants are requested to post their queries in Zoom Q&A box. Without further delay, I hand it over to Mr. Chandan Lahoti.
Thanks, Surbi, for your kind words. And again, welcome everyone for today's webinar. I would just start with if anyone has any questions on our webinar number 1, webinar number 2 with regard to various IND AS, what we discussed in detail, you can pose those questions in Q&A. We can start with those questions directly, and then if required, we can go to the next slides. I'll just wait for few seconds and then I can start directly on our topic for the day. Okay, so I think so. Rinkin has put up a question on any elaborated guidance on material accounting policy disclosure. Yes, Rinkin, as you are aware that this is a key change for the year ending 31st March 2024 audit. The difference between significant accounting policy versus material accounting policy. So at times for company, there can be various items which are significant in nature, but might not be material from a financial statement perspective. So the thin line between significant and material is a materiality concept which is now given from a company's perspective. So for example, there is a significant accounting policy which is applicable for a company for previous year. Current year, those transactions are not material enough. And accordingly, one can skip on materiality, those disclosures from an accounting policy perspective. Hope that answers, Rinkin, on your point, what you had. So if we today, I intend to cover various IND AS starting from 38, 40, 101, 103, 107, 108, 9, 113 and 115. So we will cover minimum 2 to 3 errors in the financial statement with regard to these standards. Okay. Going directly to IND AS 38 on intangible assets, as you could see in the current scenario, IND AS 38 intangible assets. In the current scenario, goodwill has been disclosed here. If you see on left side, this goodwill has been disclosed in the notes to accounts. Okay. Can someone explain, is it correct or incorrect? And if it's incorrect, what should be the correct treatment? Anyone? Put on chat box. Ravi, I would cover all your points on 115, 119. Rahul, yes. Rahul, your question is material definition will be different from auditor's materiality limit, or it will be same, it will be different? Because auditor's materiality limit is basis the reader of the financial statement, what auditor believes would be material from a financial statement perspective. And the material definition would be from a company's perspective, because company is someone who would be preparing the financial statement. So there can be difference in materiality concept, materiality amount being identified by both the parties, and the financial statement would be prepared basis the materiality of material, not materiality, material by the company. It's a wrong presentation. Rahul, can you elaborate further? Because it's wrong presentation. I'm not clear what exactly you mean. Yeah. So few chats I could see incorrect. It's separate as goodwill is not amortizable. Okay. Goodwill cannot be disclosed in PPA note as it is not tangible assets. Goodwill only requires annual impairment testing. Is not correct. Goodwill is not depreciable, only tested for impairment. Yes. Ravi, you are correct. First of all, goodwill recognition. If you see on the left side, goodwill recognition has not been mentioned in the accounting policy, that how goodwill is calculated, accounted for. That's point number one. Second, from a goodwill perspective, goodwill need to be disclosed on the face of the financial statement and not in the subschedules or notes. Third, goodwill is not amortized. Goodwill is tested for impairment. Just a question. For example, if company is in profits and company is making super profits, still goodwill impairment should be tested each year, required, not required. Few are saying yes, few are saying no. Some are saying no, not required. Okay. So the answer to it is mandatorily goodwill need to be tested for impairment each year, irrespective of the situation of a company, etc. Goodwill might not get impaired if the business which you have acquired and the goodwill which is created for that business, there will not be any impairment. But goodwill impairment need to be tested each year mandatory. So Rahul, no, there has to be trigger point for CGU. No, Rahul, in case of goodwill, which is acquired for a business, need to be tested for impairment irrespective of a triggering point. If you have any doubt, Rahul, you can put the question, but it has to be tested each year irrespective. Goodwill and intangibles and annual impairment testing could rank in. I think so that's clear. We had some questions at start. Let me also answer those questions which are if pending. Hi, sir. I have not attended last two sessions. I have following few questions. A client of ours is contemplating to start trading in options and derivatives. Okay. For the purpose of IND AS, whether only a net gain and loss will reflect as a revenue or whether the entire turnover will be reported as a purchase and sale. Now, point number one, you are talking about IND AS or non-IND AS? IND AS 15 is scope out, correct? Agreed. So, Ravi, in current scenario, where you believe. Okay, hold on. Ravi, first point, the most important is companies into business of options and derivatives? And if they are doing trading, is it allowed for your company? Ravi, those questions need to be answered. Any company which is into a business and IND AS is their financial statutory audit, that means they are into some business. Trading of options and derivatives, first of all, not allowed because it's not the business purpose, Ravi. And hence, we need to first kill there and there itself from the point of, NBFC, Ravi, may be falling under NBFC. NBFC has a different rule, Ravi. If the revenue and the asset is more than 50%, then NBFC would be triggered. And if required, we can take up this when we will discuss 115. But normally, under the Companies Act, if company is into normal business, they can't do trading. They can take forwards, they can take futures. But trading of futures and forwards for making profit is not allowed for normal companies from a company perspective. Okay. I have answered on all the questions which has come till now. If anything is there, we can take up those questions. Okay. The next point is with regard to again goodwill. Good in the current scenario, if you see, goodwill has been amortized over life of 20 years. Is it allowed, not allowed? Is it allowed or not allowed? Just a request to all of you not to put in Q&A, but rather on a chat box, okay, so that I can just see one window and I can answer on all the questions. Okay, Rinkin is saying not allowed. Molali is saying not allowed. And why not allowed? Rinkin, Molali, why goodwill can't be amortized over the useful life of 20 years if 20 years has been identified by the company? Rakesh is saying allowed. Rahul says only impaired. Okay. So, friends, goodwill can't be amortized over the useful life of the asset. Neither it would be amortized, neither a shorter period or a larger period. Goodwill is never charged to P&L. Goodwill is tested on an yearly basis from an impairment perspective. And whatever impairment, if any, is there, need to be charged to statement of profit loss account. Going to the next slide. However, sir, ISB is exploring to allow amortization of goodwill due to implication of sunset clause in many infra business. Yes, but it will come only for some restricted businesses for some restricted acquisitions, etc. Going to the next is with regard to intangible assets. So if you see here, in property, plant and equipment, there is a line item called intangible assets under development. Is it correct or incorrect? And if so, what would be the stance? Ravi is saying incorrect, but what is incorrect? Where it need to be disclosed? Anyone? Other intangibles on the face of balance sheet? Answer is no, that's wrong. It has to be on face. Rahul, separate line item or club? Separate heading of intangibles. No. So I think so few of you are correct. Uh, Intangible asset under development should be shown as a separate line item in the face of the balance sheet. It can't be clubbed under intangible assets. So property, plant and equipment, CWIP, intangible assets under development. These are the four broad category of items should be shown. Yes, that's correct. Yes. Now coming to the next item on investment property. So in the current case, investment properties are stated at cost, as we are aware, and depreciation to be charged on the same. However, what has happened in the current case, if you see, all the investment properties need to be depreciated, which was not disclosed in the current case for the current year and also for the previous year. In addition to that, the fair value of the investment property need to be disclosed. And we can discuss in detail. For example, there is a land which is available with a company, which company is not using but given a rented to their group companies or outside parties. And if that land is taken on lease, for example, for 30 years, then on that investment property, over the period of 30 years, that need to be disclosed as a depreciation under investment property disclosure. Each year, company need to do fair value of those land and disclose the fair value in notes to accounts. That's the requirement. Anyone has any questions on this? If it's clear, I can go to the next. Great. I see answers and I see it's being mentioned as clear. Next, if you see on an investment property, whether in the current scenario everything is correct or something abnormal you could see. In the current accounting policy, what is missing in an investment property from a accounting policy perspective? I'll just wait. Anyone can share their views. Fair value disclosure, correct. Accumulated okay. So I'll directly come in the current case, and it is which is very important. The number of years which the asset is amortized or depreciation need to be disclosed as part of the accounting policy, which is required, which was missing in the current case. We'll go to the next standard on 101. Typically, I have seen personally a lot of issues in 101. 101 being a standard with regard to first time adoption, and always there would be key gaps between an IGAP and an IND AS. In the current case, if you see, there were various IND AS related adjustments and a reconciliation was not given between an Indian GAAP and IND AS. Is it fine? Yes or no? Is it allowed? Is it okay? Not fine. But do you believe and have encountered any situation where there are no gap differences and hence the reconciliation is not given? Have you seen that in any financial statement? Nikhil, RICO is must. Pooja, RICO is must. I agree. But have you encountered any scenario or a situation where a reconciliation was not given and it was still fine? Rahul says, I have not seen personally. Anyone else? Not seen? I think so. It's very clear, and you will not see, because practically that is not possible, because there are numerous uh, classification classification difference between an IGAP and an IND AS from a classification perspective, which would be there in every company, either in a balance sheet or in a statement of profit loss account, and hence uh, a RICO is required. Nikhil, yes, you can mention, but those scenarios and situation will not come, because there at times in there might be, if there is an employee, there would be an OCI disclosure. If not, then there would be some or other classification, reclassification at a balance sheet. There are financial assets, financial liability. There might be various other items which has a gap difference from an Ind AS perspective and an IGAP perspective, and hence the disclosure is required. Okay. Going to the next point on the in current case, there was a gap difference between an IGAP and an Ind AS. Further, it was disclosed in an accounting policy that gain on a fair value measurement has been disclosed. Okay. Now, what has happened? Only disclosing that the fair value measurement between the previous gap and Ind AS will not suffice. One need to further ensure the impact to balance sheet, the impact to financial performance means statement to profit and loss account, and a cash flow need to be given. So at times what happens when there is a fair value measurement difference between an IGAP to an Ind AS, just the difference is given, but the impact to balance sheet, P&L, statement of profit and loss account, and cash flow is missed, which one need to take care. Any questions till now on those items, or any other question till now on any other index which we have discussed? There are questions here. I think so. Those are the ones which is already there. Those are closed. Anyone? I'll just wait for few seconds until anyone has any questions till now, because I want to take up all the questions with regard to 116. We can take up at last round when 116. Till now, for all earlier index which we have discussed, or the index which we have discussed till now, we can take up if anyone has any questions. Otherwise, we can go to the next slide. Okay. If you see the current question, it says that under the notes to financial statement, effect of index transition, value of investment and the measurement of investment have not been disclosed. So what has happened in current scenario? Before going into it, from an investment perspective, any investment can be classified majorly into two categories. Which are those? Can anyone explain in chat box? There are options in 101 for any investment to be disclosed under two different scenarios. Rahul has answered it, and that is correct. I'm just waiting for others to answer. Rakesh, we are discussing whether an investment need to be disclosed or valued at different method. Current, not current is not a question. The answer is FVTPL or FVTOCI. It's about fair value through OCI or fair value through PNL. In the current case, what has happened? The value of investments and measurement of investments were not disclosed. So from a concept perspective, if one need to understand what is FVTPL and what is FVOCI, if everyone is aware, then I will not go into it. But if not, I can explain. I will just wait if anyone has any questions. If anyone want to understand what is, okay, Pooja is saying, please explain. So under IND AS, whenever an investment need to be measured, it gives an option that investment can be measured at FVOCI or FVTPL. FVTPL is at a quarter end or an year end. If an investment, or rather not if, every investment is valued at a fair value each closing period, and the difference between the earlier value and the current value is charged to PNL. PNL means statement of profit loss account. That's one option. And option two is you can charge those to OCI directly, because management don't want fluctuation in the financial statement due to fair value changes in lot of instrument, be it equity, be it bond, be it land, or be it anything. And hence those options are given. That's point number one. There are some instruments where OCI is not allowed. There are some investments, ideally, those are not done through FE, through PNL. So for example, company has acquired a subsidiary. In that case, it is done through OCI. With regard to various others, so it depends whether it's a current investments, non-current investments, intention of holding the investment to earn, to sell, accordingly those classification is done. Which I hope it's clear and you understood the difference between FV, OCI and FVTPL. Great. So in current case scenario, what has happened? And several issues were identified in this particular matter. First, it was valued through FVTPL. However, if you see the carrying value of opening balance and the closing balance was same. So one could see that this disclosure is incorrect in nature. Further, if you see a note with regard to reconciliation was also not given. So several issues were there in the current scenario, from incorrect disclosure, incorrect valuation, incomplete disclosure, etc. Okay. So we'll go to anyone has any questions, practical discussions or practical scenario to discuss on 101, we can discuss now. Otherwise, we'll go to the next standard, which is IND AS 103 business combination. Anyone has any questions, any doubts on 101, we can discuss now, or I'll go to 103 standard business combination. I will explain what is business combination first, and then we take the next steps. From a business combination perspective under IND AS, earlier, if you remember under IGAP, we have a standard called amalgamation. That standard is not there in IND AS. IND AS, it's a business combination. And from a definition perspective, business combination covers overall various scenarios where there is a restriction under amalgamation standard AS40. Business combination covers various things, including type of a slum cell type. And when I mean slum cell, a business combination, it says it should be a business. First, The definition should have process, it should have people, and if everything is there, then that becomes a business combination. So for a business combination, the business definition need to be fit. Once the business definition is fit, then uh, this particular standard would get applicable. Now coming to the next, what is common control transaction? Anyone want to put on the chat box if they are aware what is common control transaction? Anyone? Otherwise, I will explain in detail what is common control transaction, and then we can take up. Okay, anyone want to give a try? What is common control transaction? Okay, so what is common control transaction? If there are two companies or two entities hold directly or indirectly by common person, common entity, common parent, locally, globally, as the case may be. Those are called common control transaction. Ideally, business combination standard says the common control transaction should be accounted for in a different manner as against the non-common control transactions. Because the non-common control transactions, the value attached to it is in essence a fair value. In a common control transactions, the entities are merged, and we are talking about business combination means merging, demerging, or splitting, etc. Wherever there are two businesses which are merged is called a business combination. So ideally, if you see here, it is mentioned that the common controls are accounted at historical cost. Is it allowed? Not allowed as per IND AS? Pooja, Ankit, can you answer whether on the left side of the presentation that the common control uh, transaction, when I mean of the legal entities were recorded at historical cost. Is it correct? Incorrect? Should be at fair value? No, Gi. It should be at book values. Not getting an answer what I'm looking into, because IND AS clearly says how those common control transactions to be accounted for. Which method, to be precise, giving a hint to all of you. Anyone want to give a try? In the current case, the common control transaction difference because, for example, what company is taking and what they are paying, there would be some difference. It was accounted for in a retained earning, which is incorrect. Some are saying NCI at fair value, some are saying book value, some are saying book value basis. So friends, the answer is a common control transaction to be first recorded using pooling of interest method, and appropriate disclosure need to be done as against an historical cost. And you are aware what is pooling of interest method, how accounting need to be done on a pooling of interest method, what need to be done on balancing amount in a pooling of interest method. Okay. So is it clear that common control transaction did not be recorded book value, need not record NCI, fair value, blah, blah, blah. It need to be recorded as pooling of interest method specifically mentioned in 103 business combination. Clear? Going to next in the current scenario, and we are now jumping to next standard, which is IND AS 107 financial instrument. This would be with regard to disclosures. In case of depreciable asset, the cost of an asset is shown at a gross value and the grant therefore. This is with regard to government grant. So in the current scenario, the government grant was accounted in capital reserve and charged, which is recognized as income in statement of profit loss account. Is it correct or incorrect? Government grant received, charged to P&L, taken to capital reserve, added in the gross value. Rajesh says correct. Others? And now we are talking from an Ind AS perspective. Saying not correct or saying correct is very easy. But if it's correct, then the logic and logic from the standard perspective, and if it's incorrect, the logic. So Rinkin, your answer is correct, not capital reserve, but what it should be done. It's a capital grant, Rahul. Uh, and the next step then. Okay. So from a government grant perspective, government grant gives an option wherein if a grant is received for a depreciable asset, it may be treated as a deferred income, and on a systematic basis, it need to be charged to P&L, an expense and an income over the useful life of an fixed assets on an equal proportionally amount so that the P&L is intact in both cases. Okay. Is it clear? Any questions on government grant? Okay. Next is with regard to disclosure, and with regard to disclosure, in current case, the investments are carried at a fair value. Bifurcation between quoted and unquoted was not given. Is it fine or it is a mandatory? Quoted and unquoted, incorrect disclosure, it's mandatory. What all additional things need to be disclosed over and above quoted and unquoted value of the shares? Any additional items? I could see some answers. Yes, Pratik and Lincoln, you are correct. Over and above quoted and unquoted market value of that investment need to be disclosed mandatorily in the financial statement, and that need to be disclosed, which is required as per division 2 of part 1. Impairment of investment, Pratik, if it's applicable, otherwise not. So disclosing of an impairment of investment is subject to impairment is triggered and under the notes. Otherwise, it's not required. Okay, very interesting. And I will spend minimum 5-7 minutes on this particular item. There is a case where a contingent liability of a company included letter of comfort to bank against a credit facility, financial assistance availed by the subsidiary, and a corporate guarantee is given to the bank against this corporate guarantee. So in the current scenario, which is a letter of comfort, do you believe any disclosure is required? Point 1. And everyone need to answer, give 2 answers in the chat box. Whether any disclosure is required, yes, no, and whether any accounting treatment is required in the current scenario in the financial statement. Everyone need to answer 2. Guarantees, contingent liability, and comfort letter not required. Should be disclosed, but not as a contingent. No accounting treatment required. Rahul has answered. Pooja has answered. I want minimum 10 answers in the chat box. Rinkin, can you just further elaborate? Because I think so. Disclosure is required under credit risk. Accounting treatment also requires a financial liability to be valued at Can you be more specific? If accounting treatment is required, under what? Okay. Okay. Rajesh, in the current case, you are saying it's a corporate guarantee required, but the company has issued letter of comfort and not corporate guarantee. What you will do in the current scenario? Rinkin, financial guarantee is covered under IND AS 109. Whether letter of comfort would be classified as a financial guarantee. So in current case, and specifically which is mentioned in 109, this is very, very, very important. So at times, what companies are doing under IND AS, that corporate guarantee is already covered for an accounting, they are issuing a letter of comfort. One need to understand that is it a letter of comfort or it is a financial guarantee. If the letter of comfort is given, which is not used as a financial assistant, then it would be just a contingent liability, not an accounting. But in the current scenario, what has happened? The letter of comfort was given for taking a credit facility. Subsidiary has taken a loan against it, and that letter of comfort clearly mentions that if in case of default, one need to recoup from the parent. And in the current case, the accounting will be the same as that of financial guarantee because in contract legally meets the requirement and hence accounting need to be done. So Rahul, what is happening? Companies are just right, left, center issuing letter of comfort, but that letter of comfort is in real essence a financial guarantee. One need to assess whether that letter of comfort is just a letter of comfort or that letter of comfort is a real financial guarantee. So one need to assess, ask those right set of questions, and then take it forward because many cases are happening where under the uh, garb of letter of comfort, financial guarantees has been issued. Okay, one question is if term loan. Okay, let me see that. If term loan is 100% guaranteed, but outstanding liability due to payment is 70 lakhs, so disclose amount outstanding by subsidiary. No. So Nikhil, in this current case also, you need to disclose full guarantee amount because the obligation between both the parties is that 100 lakhs and not 70 lakhs. Is that clear? Letter of comfort need to be assessed as it meets the definition. Rinkin, you are correct. If given on behalf of software associate and disclosure plan, yes. I have issued article in IC on same topic. Oh, great, Rinkin. Thank you. Okay. Going to the next, which is IND AS 115. I have just added one question on IND AS 115 because I am assuming there would be a lot of questions already coming from your side on 115. But this typical, I thought of having discussion on this particular item. In the current case, the company has shown interest income in the financial statement as an exceptional item. Such interest income was recognized during the reporting period and the comparative period. The receivable corresponding to the same amount is written off as not recoverable during the reporting period. What are different issues? And we'll discuss that in detail. I want minimum 5-7 answers in the chat box. Not to be shown as an exceptional item. Okay. That is correct. However, one need to assess whether it was an exceptional item or not, because as per IND AS, it is clearly mentioned which are the items which can be disclosed as an exceptional item. In ideal scenario, interest income will not form part of exceptional item, but one need to still assess. I'll not point blank say it's not allowed. One need to assess whether those 5, 7 items which is mentioned in the index, whether that falls under in the current scenario or not. Need not be shown as no. I think so. One need to understand. Hold on. Geet, Rahul, uh, Prasanna, just hold on. We are talking about 115 and you are talking about exceptional item. Yes, that matter what you are specifically mentioned is correct. But we are discussing from an 115 perspective, what is an issue in this matter. So if you see an interest income was shown as an exceptional item, means this is not a normal routine income. Second, both the years interest income was shown. If you see in year 2, that item was written off as not recoverable. So what are the different items which will trigger in the current scenario? And I'm just trying to cover a lot of items under 115. What does 115 says from a revenue recognition perspective? What need to be assessed from a revenue recognition perspective at start of the year? When right to receive arises, that is fine, over and above. The amount is recoverable. One need to assess on the day one because it's an exceptional item, accounted for, directly written off. So in current case, several issues. An interest income was recognized during the period. Further, the receivable, blah, 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 should be recognized only when it is probable that the economic benefit associated with the transaction will flow to entity. Clearly, in the current scenario, it seems that that was not tested correctly. First, whether the recoverability was certain or uncertain on day one. If yes, then fine. If not, whether the ECL was tested or not, which is very important. If you see year 1, revenue recognized, year 2, written off. ECL was also not tested. If the revenue recognition was correct at first place. So every time one need to assess whether the amount is recoverable, not recoverable, and every year end an ECL need to be tested in the current scenario. I thought of, as this is the third session, let's spend more time on various questions on various other indices. So we can directly take up now questions. I've just taken, so those are the only questions from my side to be discussed. But like few had questions on 116 and various other items, please start posting those on the chat box and we can start discussing and try to resolve all those items under index. Any questions? So someone had on 116, you can post now. And we can discuss on that. Few of you had a question on 116 or any other one plant capitalized on Jan 124 and before that trial run inventory produced. Okay. Okay. So this is nothing to do with 116. Correct, Rahul? The question is with regard to PPNE. And what do you mean? One plant capitalized on Jan 24 and before that trial run inventory produced. So in the current scenario, if the asset was ready to use on 1st Jan 2024 and inventory was produced. So income recognized from that inventory, net of inventory cost to be capitalized under PPN. So 100 rupees of fixed assets. If, for example, you have sold that inventory in 20 rupees and you have earned 30 rupees. So that 30 rupees entry, 20 rupees entry, everything goes to sold in March 24. Nothing will happen because the items were sold post uh, assets are capitalized. So there is no income or expense earned before capitalization. If post capitalization items are sold, which is in normal course of business, no accounting treatment separately need to be done. Architect fee and campus administrative paid to consultant taking campus on lease will be part of ROU or kept as PP&E. So, Pooja, I'm not understanding your question because architect fee and the campus administrative fee for taking campus on lease. So, first of all, you will need to understand whether those expenses are incurred for a PP&E, which is a property of a company, or an ROU asset, because both are different items. You can put the questions correctly, and I would definitely help you answer that. In case of Ind AS 110, whether investor-investee relationship is required, there need to be at least some investment in the company to fall under 110, yes, or by way of control or a board along with a major transaction of the company, consolidation would be required. Can you specify, Pratik, some of the cases, and I'll explain, because there are some items where without having the equity, consolidation can happen. To give an example, Pratik, uh, PF trust, ESOP trust, where there is no investment, still consolidation can happen. Pratik, if you have any specific question, we can further discuss. So, Pooja, uh, if an architect fee and the campus administrative architect fee is paid by whom? If you have taken an asset on a lease, why you will pay an architect fee? And hence I'm not clear. For Rahul, so inventory produced on that day has to be capitalized with uh, cost of asset. Rahul, you can't do single leg of entry. If inventory is capitalized, then revenue also should be netted off. Otherwise, inventory and revenue both should be in a normal course of business. Ideally, company produce a lot of inventory items as part of trial run, etc. However, if inventory is produced and sold before capitalization, need to be netted off in fixed assets. Even though if it's before capitalization, answer is yes, Rahul. Because uh, you can't just capitalize that inventory in fixed assets and you recognize revenue in a P&L without any cost. It's not a matching concept under Ind AS also.
There is one question, Chandan, there is one question in the Q&A box. It's by Mr. Ajit Bhagali. He says, sir, mutual fund is always valued at FVTPL. Is it correct?
So, Ajit, the question is very important. One need to assess whether. So, I would answer in two different things. First, if it's case of 101, first time implementation, that option is available. And when it's a normal course of business, then mutual funds are taken by the company for investment purpose. At that point of time, you need to do it, you can do it through FVTPL. But a mutual fund kept from a long-term perspective or even a bond, you can do through OCI. That is fine. It's not mandatory. Is employee gratuity trust required to be consolidation? One need to evaluate basis the terms. Bhavin, there are scenarios where employees gratuity trust are consolidated. There are scenarios where it's not consolidated. But one need to assess whether all those criterias and conditions are meeting. That, for example, whose obligation it is, whether once the amount is transferred from the company to the fund, then fund need to manage, then it's fine. If not, one need to assess. But normally, PF and ESOP are something where consolidation comes in place in many cases, gratuity in rare, because from a gratuity perspective, it's about defined contribution and defined obligation. Uh, Mutual fund investments where valuation would be level 1, level 2. For mutual funds, if it's listed, Rinkin, it would be level 1. If it's not listed, it's level 2. I have seen various mutual funds which are not listed. And accordingly, level 1, level 2 is done basis uh, whether it's a listed or not listed. What is level 1? Level 1 is something where readily available price is available. Level 2 is where readily available price is not available. Pooja has some questions. So we will continue taking questions until there are questions. So we have the companies planning to take campus on rent will be completely built by landlord. To monitor the project, material used and designed of campus companies hired personal license to the company. Can we capitalize this as lease on building improvement or have companies planning to take campus on rent will be completely built by landlord. To monitor the project, material used and design of the campus company hired. Yes, you can factor those, Pooja, in the current case. In our because the standard clearly says that any allied cost like stamp duty, etc., which is directly attributable, can be forming part of the RO. To elaborate my question, even employees of the investor company are shareholders and the board of the both the companies are same and the board of holding companies are shareholders. Pratik, what I understood your question, but what is your doubt in this? What industry practice to present insurance receipt and FA or inventory loss? Rahul, can you elaborate further? I mean, flood making loss of inventory is. So, Rahul, in the given scenario under Schedule 3 specifically, it is mentioned if the expense and income are there, you can club and net off the financial statement in the other income or other expense as the case may be. We can show net. That is fine, Rahul. Pratik, whether consolidation is applicable. Consolidation need to be tested from a control perspective, Pratik. Uh, Let me try reading your question and I will see whether I have a plain answer. If an employee of an investor company or shareholder in investing company, the board of the both company are same and the board of the holding company are also the share. Not necessary in the current scenario. Only if the board is same, investors are same, then the consolidation happens, not necessary. One need to assess whether uh, control is established or not. And if control is established, Pratik, in the current scenario, yes, it need to be capitalized mandatorily. Pooja has some question. The company is planning to take, that's done. I think so. As of now, I've answered all questions. If any question is there, you can put again. And if I've missed any questions, you can put again on the chat box and I'll answer all those questions. So as of now, all question answer. If I missed any, please put on the chat box again. And hope I have answered all your questions. However, if you have any questions which are still unanswered, you can reach out to me on my WhatsApp number, on my LinkedIn, as the case may be. I will try to help you solve your questions on IND AS or any other topic which I am competent of. Uh, Thank you.
Thanks so much for the session. Very good and enlightening. And I'm sure uh, the participants have really enjoyed the session also. And yes, for the questions, as Mr. Chandan Lahoti said, that you participants can reach out to him directly, or maybe if you want, we can also post some questions from your side and he'll answer. And we will soon come back with more insightful sessions in future. So thank you so much, sir. for the extremely interactive session, I must say. And thanks to all the participants for some good involvement. And we'll see you all soon. Bye.
No. Thank you. Thanks, everyone. Thanks for joining and taking out time. Thanks, Tax Sutra.
Thanks, sir.